Welcome to the Techno Fundamental Report for June the 20th. You know, bull markets come out of the night. It's when you really least expect them. Same is true for bear markets. I mean, markets are designed to fool most of the people most of the time. So if it doesn't do that, it's not a market. So basically, it's all based on human behavior or the perception of the future. That's what drives stock prices. Now, liquidity is an important concept because when you look at the large institutional investor, let's say you're managing billions of dollars, if not trillions of dollars, there's not as much liquidity in the marketplace. It's basically a question of efficiency and how easily can a security be converted to cash. Now, we have found that the best way to look at liquidity is to do what we call a dollar volume measurement. So in other words, if a stock trades, let's say 1 million shares a day, it's a $100 stock. That means it trades approximately $100 million per day. So we're pretty much of the opinion that most institutional investors will avoid securities that lack liquidity, meaning that if you do dollar volume, you're going to be at less than 40 million a day. Anything less than 40 million a day, I think, has a question mark. The approach that we use is basically a bottom-up approach. We're looking for companies, and then we want to be in the right sectors. We're going to talk a little bit about that in the video. But you have to kiss a lot of frogs to find your prince, because if you remember this report that I've shared with you many times in the past, most public companies are duds. I mean, this is based on a book called The Psychology of Money. It quotes the J.P. Morgan study that was done for 24 years that basically pointed out that over that 40-year period, 40% of the Russell 3000 stock components lost at least 70% of their value and never recovered over this period. So you have to realize that you have to be a bottoms-up approach, which means find the individual companies that are going to be successful. Now, in the J.P. Morgan report, they show all the successful companies in their study, and you can see a great deal of them were consumer discretionary, technology. The shortest list were things like energy and materials. Healthcare was pretty healthy as well. Now let's just take a look at the market. It is frustrating right now because this is a very divided market. Some stocks are doing well, some aren't doing well. The Magnificent Seven, which is 7 companies, are pretty much leading the market because you can see here that with the NASDAQ, it is hitting new highs, but the advanced decline line, meaning how many stocks are advancing, how many stocks are declining, gosh, it's about to hit a new low in here, and it's just showing you the divergence. Now, another way to look at it is looking at the percent of stocks above their 50-day moving average on the NASDAQ. Less than 50%, and you got the index hitting a new high. It means that this index is being driven by just a few stocks. Most stocks are continuing to struggle. This is the value line geometric index. You can see it's basically going nowhere. This is a 1,700 stock index that's geometrically weighted, which means every stock of the 1,700 are equally weighted. This is not market cap weighted, which I think is somewhat deceptive. So you can see here with this geometric index, it's pretty much moving sideways. The other thing that's been troubling here is that the new lows on the New York Stock Exchange have been extraordinarily high. I guess all this just really boils down to stock selection, and just make sure that you're getting involved with the right companies. There's a lot of new lows here. That's just not a positive sign. Again, to make the point, I'm comparing the Russell 2000, which is small cap stocks, to the S&P 500 index. You can see that ratio just hit a new low. So it's like I say, there's just a lot of divergence here. It could be some form of a warning, and it may be nothing. I mean, we may have to just basically keep your eyes open here. Now, the group that is really leading the way, and there's of course a region, is the semiconductor stocks. This is the semiconductor ETF. You can see it's just parabolic. I mean, it's just blowing out of here. The point being here is data centers. With the NVIDIA breakthrough on hyperconvergence. We're going to see a major build out and retrofitting of cloud-based data centers, and we're going to go to what they call hyperconvergence data centers, which is going to be substantially faster and have some problems, which is use of energy. That's going to be one of the big problems. So let's just take a look at some of these semiconductor stocks that appear to be involved in these data center build-outs. This is Broadcom Semiconductors. You can see here, nice volume cluster of buying, a breakout on very positive earnings results, and the stock is definitely in an uptrend. You can see the trend meter is in the green. Both relative strength lines are in a positive way. So let's just look at a few more. Here's the old NVIDIA. You can see here, very nice tight pattern in an uptrend. You've got, you got the breakout on volume here. Now, we're not getting a lot of volume here lately since the stock split. However, continues to be in an uptrend, looks positive. This is Qualcomm, another semiconductor. Now, this is kind of an old name, been around for a long time, mainly involved in cell phone technology. You can see here on last trading day here recently, big volume, nice breakout. Everything looks pretty positive. Taiwan Semiconductor. Now, we do own this stock. They manufacture semiconductors just about for everybody. They manufacture semiconductors for Apple. They don't design the semiconductors, they just make them. So as the semiconductor boom goes, this is a great way to play the whole group because they work with just about every company. But it's in a very powerful uptrend, hitting new highs. This is Cirrus Logic, which is a very small. Now, so back to what we talked about on the volume signature, where we do dollar volume. So you can see here the only negative about this little company is, we're talking about roughly a $7 billion company, and I mean, we're in a $1 trillion world now, so $7 billion is actually considered mid-cap, but it's on the smaller end of the range. But anyway, if you look at volume, let's just round off, roughly 500. This is the 50-day moving average on the daily volume. Now, roughly 500,000 shares. It's a $127 stock. So, you're looking about, 60, 70, 80 million a day in volume. So it's on the small side, but I would still keep an eye on it. So if you have any questions, let me know. Thank you very much. Have a good day.